Tesla's ability to scale its units is crucial because each vehicle represents potential for a future robotaxi fleet. The stock price target for 2027, based on a 5-year investment horizon, is expected to be around $2,000, with a range between $1,400 and $2,500 in base and bullish scenarios. Regulatory changes appear to be working in Tesla's favor. For nearly 3 decades, annual auto fatalities in the United States declined to around 30,000, but in the last 5 years, they have surged past 45,000. This increase puts pressure on the National Highway Traffic Safety Administration to take action. Tesla released data on Investor Day, which many overlooked, showing that with full self-driving, Tesla vehicles are involved in accidents every 3.2 million miles, compared to every 500,000 miles for the average car on the road. The global robotaxi market could generate between $8 trillion and $10 trillion in revenue by 2030, making it one of the most significant investment opportunities of our time. The robotaxi service will function similarly to a software-as-a-service business, making unit production an even more strategic move. Autonomous driving is expected to eliminate human error, responsible for 80 to 90% of auto accidents, potentially saving countless lives. Tesla's stock remains undervalued despite the latest long-term forecast, showing significant growth potential. Initial predictions assumed Tesla would lose 1/3 of its market share due to increasing competition, but that assumption has changed. In 2018, Tesla held 17% of the global EV market, including China, and instead of shrinking, its market share has increased. Many traditional automakers struggle to compete due to battery technology constraints. Unlike Tesla, which pursued the consumer electronics cost curve early, competitors rely on costly lithium-ion pouch batteries. To match Tesla, they must sell electric vehicles at a loss while simultaneously phasing out their internal combustion engine business. Within the next 18 to 24 months, EV prices are projected to fall below those of gas-powered vehicles, and costs will continue to decline as battery production scales. General Motors, for example, allocates only 10% of its $25 billion R&D budget to EVs, when it should be nearly 100%, given the shift in market dynamics. Germany's decision to invite Tesla to build a massive factory in Berlin underscores the urgency among traditional automakers to adapt. Tesla holds several key advantages. First, its battery technology is significantly ahead of competitors, allowing it to achieve lower production costs. Second, it develops its own artificial intelligence chips. Analyst James Wang, who worked at NVIDIA for 8 years, reviewed Tesla's chip specifications and estimated they are at least 4 years ahead of other automakers. AI is critical for autonomy, and Tesla has a significant lead in real-world driving data, with over 14 billion miles collected compared to just 20 million from its closest competitor. Lastly, Tesla remains the only automaker that can deploy over-the-air software updates to enhance vehicle performance, solidifying its position in the market. Tesla is rapidly scaling the EV market, with global sales expected to grow from 1.3 million units last year to between 23 and 26 million units in the near future. While this exponential growth is impressive, the real story lies in the autonomous taxi platform. Tesla is transitioning from a low-margin hardware business, with gross margins of around 25 to 30%, to a transportation-as-a-service model with 80% gross margins. Fleet operators will rely on Tesla's platform, allowing the company to take a share of every ride. Elon Musk discussed this transformation in a recent podcast, emphasizing the convergence of major innovation platforms such as DNA sequencing, robotics, energy storage, deep learning, and blockchain technology, each representing trillion-dollar opportunities. The base case 5-year price target for Tesla stock is $7,000, derived from probability-weighted scenarios, including conservative cases where Tesla faces setbacks. The confidence level in this target remains high. 3 key factors contribute to the revised price target. First, Tesla's market share has defied expectations, increasing rather than decreasing despite new competition. Second, autonomy represents a recurring high-margin revenue stream. Much like a software as a service business, the general market underestimates Tesla's potential in this area, focusing on traditional auto gross margins of 30%, whereas Tesla's battery technology alone could push margins to 40%, with autonomous revenues exceeding 80%. Lastly, scenario testing assumes only a 25% probability that Tesla will have fully operational autonomy within 2 to 3 years. If autonomy progresses faster than expected, the stock could rise significantly sooner. Tesla's success is driven by the convergence of multiple innovation platforms, making it difficult to analyze using traditional financial models. The company operates without relying on subsidies, unlike many competitors. Tesla is uniquely positioned as both an EV and an AV manufacturer, ready for widespread adoption. The electric vehicle market is projected to reach 37 million units in 2024, representing over one-third of total auto sales. Tesla's battery cost advantage forces competitors to either sell at a loss or price their vehicles too high to compete. In addition to its AI chip leadership, Tesla's real-world driving data collection surpasses all rivals. It has accumulated over 14 billion miles compared to Google's 10 million, reinforcing the advantage in training autonomous systems. Autonomy accounts for 90% of Tesla's valuation, and its probability of success continues to rise. Companies like Waymo have already laid the groundwork, but Tesla's 7 million vehicles on the road provide a data advantage no competitor can match. If national legislation supports autonomy, Tesla will be in a prime position to lead the market. The latest trades reflect this confidence, with Tesla shares being added across all strategies holding the stock. An upcoming report will further update perspectives on Tesla's ride-hailing potential, which could serve as a bridge to full autonomy, significantly reducing risks and increasing profitability. Many analysts and investors failed to fully credit Tesla's autonomous potential. If they did, the stock price would be much higher. However, more investors are beginning to recognize Tesla's leadership in EVs, battery technology, and AI. Tesla has collected over 30 billion real-world miles of driving data, compared to Google's estimated 30 million, and remains the only automaker capable of modifying vehicle performance via over-the-air updates. The autonomous ride-hailing market presents a $7 trillion revenue opportunity, yet the current market cap of human-driven ride-hailing companies worldwide is only about $200 billion. If Tesla succeeds, it will dominate the U.S. autonomous taxi market, which is expected to develop into a natural geographic monopoly. As confidence in Tesla's autopilot capabilities and data collection grows, so does the probability of success in autonomy. The total autonomous market could reach between $6 trillion and $7 trillion, with the U.S. alone representing a significant portion of that value. If Tesla captures a third to half of this market, the upside is massive. Investors tracking Tesla's progress in autonomy and ride-sharing should consider the implications for future growth. Tesla's stock remains one of the most compelling investment opportunities, with significant room for appreciation as the company executes on its vision.